Hey, good afternoon, everyone. Excuse me for 1 second. Okay, we still have people coming in, so we're just gonna let's hang out for about 60 seconds. And this is a little bit of a preamble. We worked on price action for the first two modules, and then we looked at price action and market structure in the third. And what we're going to do today is we're going to do some real difficult price action market structure setups. And really, what we're going to do is we're going to try to find these patterns in JPEGs that I've already built. And I found out how to actually draw on the JPEGs that are in the slide deck. And then the next slide actually portrays these a little bit better. I think this is the most difficult component of day trading, or swing trading for that matter. And this is the part of swing trading and day trading that a lot of people just don't learn. And if you don't learn this, when you start adding complexity with volume and indicator confirmation, you're going to use that as more of a crutch. This is really the nuts and bolts of trading, and this is really the bedrock component and the foundation. And this is really what you have to master if you want to move on to the next level. If you've been in the live trading room, you see that if you take these with indicator confirmation, they're oftentimes low risk, high reward types of trades. And we still have people coming in, so I'm not so good at filling in time here, but I'm just going to do another couple of minutes. Actually, what I'm going to do is I'm going to do the introduction slide now. So what we're going to do is, and the way we look at trading price action and market structure is whether you're entering on a single candle configuration or whether you're entering on a multi-candle configuration. Our single candles our single candle entries are either C candles, dark cloud covers, or piercing candles. For the most part, as you know later on when we move to indicator confirmation, we can always give that a little bit of play. But right now we're going to stay with our most conservative entries and the ones that conform to all of our trading rules. So these are our single candle entries, and there are no others. Then we have entries out of a single candle, but they're based on a multi-candle configuration. The two most, well, there's really, I was going to say two most important, but they're really all extremely important. There's the trade out of consolidation, in which there's a consistently, in which is a series of candles with lower highs, lower lows, or higher lows and higher highs, forming a channel. I'm sorry, that's a channel. Or whether we have consolidation, in which volatility drops and price action just moves sideways. And then we look for double tops, double bottoms, and those are slightly riskier trades. We have to be very careful, and we're going to go over those. And then if you remember early on, we talked about tweezers formations. And those are very, very effective entries. So those are our more complex entries, with the C candle, dark cloud cover, and piercing being the single candle entries. Now, the last module went over 2.5 hours, so it's very difficult for me to judge how much time we're going to take. But I do have quite a lot of slides, so we're going to start. Now, we're going to start with a blank chart. I'm going to move over to chat. Okay, Ted, let me just check that. No rest, okay. Some examples show candle B not appearing immediately after the second candle. Instead, there was one candle before the B. Is there a max number of candles that can be between the A and still be out of? There's no max number. Well, let me show you, Ted, exactly how that works. Okay? I'm going to actually put it on here, because what I put on this slide is to look for the best long trades. Now, for some reason, I was under the grave misconception that I actually could draw on this, and I believe that I can. Let me just find the deck that I'm projecting here. Or let me get Sergio, but I think I can draw on the slide. I just have to know how. I may not be able to. Just hang on 1 second. Let me find out from Sergio if I can actually draw on this. So I want to be able to, so I can show you the answer to your question, Ken. Hang on 1 second. Okay, in projection mode, I don't have that option, but I'm gonna be able to answer this. Hi, Julia. I can, and you know what I'm gonna do? That's what I'll do. Hang on 1 second. I have all these slides somewhere. Hold on 1 second. I don't want to blow these out. Okay. Just tell me if you can still see them okay. Here's the slide. Can you still see those all right? Are they still projecting okay? Okay. All right. Thanks, Roger. All right. Okay. Good. Thank you. Okay. Here's the answer to that. The A candle. Let me just get the text here. I don't know if I can actually put text in, but here's how I can show it to you. This is the A candle right here. Now the reason it's the A, and I've gone over this before, but it's not a problem to review it. That's the green up candle. Now the reason it's the A is because you have two green candles in a row. That creates the A. Now the earliest the B can come is on a retracement off of the first two greens, because you need two greens in a row to print an A. So the B is going to be your retracement candle. So this is your B candle right here. And here is your continuation. This is not a C, but this is a continuation on a Pearson candle. This is your A, this is your B. Now this entire formation is going to disappear, because unless this candle can engulf the B, the ABC pattern disappears. But the software will print an A. The earliest that it can print the B is on the first retracement after two confirmed candles of the same color in a row. So that's the quickest you can get a B after you get it in. Now, let's look for the best long trades here. And here's how, I'm going to show you how I always do it. Instead of just looking at all these candles, the first thing that I do is I look for periods of consolidation. So I have consolidation here, and I have consolidation here. Then I look for more consolidation. I have consolidation here, because consolidation is usually pretty easy to spot. And I have consolidation here. I have consolidation here. And I have consolidation here. So now what I've done in a chart that's just got a whole bunch of random candles, or a chart without market structure, created some market structure on my own. So automatically, what we have now is we've given ourselves 3 long trades. Here's one. And remember, we want our long trades out of consolidation to be piercing candles to the upside. And there's our first long. And here's our next long, right here. And here's our next long, right here. Now, we're not trying to predict when there's a break. All we're trying to do now is, I'm sure everyone's heard the term chartist. And a chartist basically just sits in front of charts and studies price patterns, studies market structure, analyzes candles. And that's what we're doing. There's no answer to saying, well, why wouldn't you take this candle long? That's not really what we're doing right now. What we're doing now is we're looking back and learning how to spot structural formations, price action trades that we can take. And you can see this trade out of consolidation works. This trade out of consolidation works. This trade out of consolidation works. Now, here's the thing that I've mentioned, and it gets more complex. Because remember, the last 2 candles in a row going into consolidation here is a short trade. That's the last 2 candles. So your anticipation is for a continuation short only here. And if we were pure price action traders, we would take this trade short and we would have gotten a loser. But what we're doing now is we're adding our own market structure. And our own market structure is serving to censor some of these trades. And also what we're doing, remember, we're trading without the 50 and without the 15, and we are actually doing a retrospective analysis. And what we're seeing is how if you just trade pure price action alone, you're gonna wind up getting a lot of losers. Now, if we had the 50 and the 15 in here, I would be willing to bet that we would be looking at a market where we couldn't take a short trade. So we're just jumping a little bit ahead. We're not doing anything beyond. We're not taking a step beyond making this more confusing. What I want to do is allow you, and I'll answer your question, Roger, is allow you to take a look at what the market has already done. It's the only way you're going to see these patterns develop in real time. So we have a long out of consolidation here, a long out of consolidation here, and a long out of consolidation here. Let me just read. Four is the minimum. That's what I like to look at. I mean, that's my own definition, and that's when we've had the indicator define it. We need 4 candles on an 8 range. The candle bodies can be no further apart than 12 picks to form that consolidation channel. None of that is written in stone, but that's just the way that we have optimized it. We're trying to get the cursor back here. For us to provide us with the best type of consolidation. So the more candles past 4, the more explosive is the potential move. Finally, after this long period of consolidation, that's a pretty explosive move to the upside. So here's what we pulled out so far. Now we have to look at whether or not we have any other additional entries. And what I would always do first is not look for the single candle entries, because those are the toughest to spot when you first look at the chart. Let's look at multi-candle patterns first, and then let's look at single candle entries. Now I'm going to show you a few more. Now, if you look inside here, what you have is a falling triangle inside a falling channel. You can see that you have 2 equal highs, 2 lower lows, and then you have the sequential lower highs here, 2 equal highs, then a lower high. Then here you have the lower low, lower low, lower low, and your entry can be optimally, and you can see that none of this is that easy. Can be here. It's not a dark cloud cover, but it's a very, very good trading pattern. Let me try to make this a little bit clearer. This one looks a little bit better. Not so easy. I don't think I can do it. Here we go. So you can see the triangle that's falling, and you also have a falling channel. Now you only need one of the two. You need the falling channel, or you need the falling triangle. Either one indicates a nice short trade. This is a very powerful setup, and it shows you that the power of the bears as this candle formation moves across the chart is increasing, and the power of the bulls is weakening. You're getting sequential lower lows, sequential lower highs. This equal high is what creates the falling triangle within the falling trend. Now, we're not going to talk about whether this is a counter trend channel or a channel with the trend yet. What we're going to do is we're going to look for trends. Now, if we look for any single candle entries here, you're going to see that there just aren't any, based on our rules. This is a short. Here's the long, no continuation short. Here's the short. I guess we do have a trade here. And you can see it fails. But we just want to note it. That's really all. Here we can only take a long trade. This is a long trade. Here we have sequential lower lows, and here's another move. See, the reason I don't want to chase these single candle entries is because right now, when you start really trading price action, you see the amazing number of them that fail. So we're going to look at the single candle entries, but really what we want to look at and pay more attention to are going to be our candle formations, our multi-candle formations. They are going to be what are going to carry us. Later on, we're going to move over to looking at single candle entries. Now, every entry is a single candle. What I mean a single candle is just a continuation, a pullback, and a move, and a continuation trade. And they're the easiest to spot. These are the toughest, and these are what we really want to pay attention to. And these are the ones that we really have to work on. Here's really what the way I just laid the slide out. I just wanted to show what I thought was the nicest trade. And this is the nicest trade because it has the longest period of consolidation. So it actually, if you take the move out here, and let me tell you, it's not any easier to learn than this. It just takes a lot of practice. If you take the move out here, remember, this candle doesn't break the channel. You want to take the first candle that breaks the channel. That's your object. And that's the candle that breaks it. Now, this is not really a break because there's no candle body. And you need a full candle body or 2/3 of a candle body above the channel. That's going to be your first entry candle out of consolidation. And that's this candle. Now, where's the best place to buy long on this chart? Now, I put this slide up. What I wanted to show you were the best single candle entries. Now, later on, it's hard. I left the times down here on most of them so that you could give me a time, but I just want to do these because I want to make it clear where we are. But here's your A. And the reason it's an A is because you have the two greens in a row to the A prints. Here's your B. First pullback. We're gonna get to it, Roger. I'm just gonna go over all of these. You're correct. You're absolutely correct, Roger. That's your nicest, and that's what I'm doing right now. Here's your best continuation trade on the chart. That's your C engulfing candle. That's going to print your A, your B, and your C continuation long trade. And that's a really, really nice trade. Now remember, here's another thing that I want to make really clear. And that is, a candle can be an A and a C at the same time. Because what you do is you get a pullback. Whoops. What you do is you get a pullback here. And you get an engulfing candle here. Now, it's really the second retracement in a trend, but by the way, and the software is actually going to define it. It's going to start over again. And what it's going to do is, you're going to have the C here, but it's also going to put an A here. Oh, can't get it to go straight up. That's okay. So this is going to be a C and an A. This is going to be your second B, and then here's your second C. Now we know from our modified Elliott wave theory that our goal is to take this trade all the way to the top and to let this retracement go, ride it out, and continue to trade through to as high of a move as we can. But based on risk, and I think the most amount of risk that you should take on a trade is a reversal candle. You're going to be out and re-enter. And the software is going to print on this second entry another C. You're going to get an A and a C here, a B here, and a C here. And then it will temporarily have a B here, but since there's no engulfing C, that whole ABC pattern will disappear. So this is your best move right here, without a doubt. Now, if you look around for other continuations, you do have one here. If I didn't draw this as we went, it just wouldn't have as much, I think it wouldn't be as teachable. Here's your dark cloud cover. I'm sorry, your piercing candle for your continuation. Here's your A. Here's your B. But because this is not an engulfing candle, the A and the B will disappear. But you still have an entry here, and you still have a winner. Now you get another pullback here, and the potential for another re-entry long here. It's only the second retracement in the trend, and that would probably get you a second target. That's pretty much all there is on the chart. This is really all you need to see. The first ABC pattern, the second ABC pattern, the first ABC continuation on a piercing candle, second also on a piercing candle, both get you winners. If you see that, then you see about as much as you can see on this chart. And all you need to do to reprice action. Now this is what I just put in. Here's the first retracement in an uptrend. This is an engulfing candle. I don't, Roger. I don't. And it confirms that buyers are firmly in control. And remember, what's nice about the piercing candle, the dark cloud cover, and the engulfer, are they tell you that you have buying and selling conviction strong enough to give you follow through and stop out all the traders in the counter trend candle, and that's really, really key. Let me just slide down here. Now this was a little I just wanted to show this to you. Because we're going to start looking at more complex patterns. Here's the first move up, retracement, continuation, move back, continuation. Here's the third pullback and continuation. That's the iffy continuation. So first retracement you always take. Second retracement and continuation you're always going to take, unless it's into support or resistance. The third retracement and continuation is the one that you have to be careful with. And what I wanted to show you here was a double bottom. in a rising channel. Now remember, double bottoms and double tops include the wick. The channel does not. The channel only is based on candle bodies. Triangles only based on candle bodies. But tops and bottoms use the wick. And that's just Japanese candlestick dogma. So there's the low. It's almost at the bottom. It comes back, and really what you have is a double bottom. Now, I wanted to show you this here. And these are very, very difficult to trade, but I simply want you to be aware of them. This is more than just a channel. The channel is 3 sequential higher highs. Now this is not a lower high, not a higher high here. This one's a little tough. But this and this candle do form a nice channel. And although this one comes back, it doesn't quite come back to the channel low or form a lower channel. You can see that it stays in that channel. It comes back into the support of the channel. So what you do have, and this is tough market structure to see, and it's a tough market structure to trade, but I simply want you to be aware of these, because what you do is, this is your tough entry, but you have a potential entry here, and then you have another potential entry here. Now, it's not based on Fibonacci, it's not based on an 80% retracement in the trend. I don't trade those. You simply define a channel, and it's really defined by the first 2 candles, and even if you move it, you can see that this candle does not break that channel, and you can take this long trade here. Now, if we take it further, hold on one sec. I don't want this to seem like voodoo, because it really is not. Oh, I can't make it bigger. I'm just going to make another one. You can see it continues. Now, if you can spot these, I'm telling you, they're going to give you great entries. I had one yesterday off the E-mini that went 2.5 points. We didn't get all 2.5 points, but that was a falling channel. And if you can see these will give you reliable entries, as long as the entry is an engulfer, a dark cloud cover to the upside, a piercing candle to the upside, or a dark cloud cover to the downside. Let me just see. No, Roger, I agree with you. Here's the thing. I don't want to bring momentum and I don't want to bring indicator confirmation into these trades yet. What I want to do is I want to stay with just trading price action. Because later on, we're going to confirm these trades. Like any one of these trades in these channels, obviously, confirmed by order flow and momentum below, confirmed by a rising 50 and a rising 15, are going to increase the predictive value of the trade. Here's the thing that I'm trying to do with this module, and that is, first, allow you to see the entry. Because if you don't see it, then you can't even make an assessment of the entry and look at indicator confirmation. There's no indicator that's going to give you this entry. Now, this may be a strategy entry. It's not going to be a consolidation entry, and it's not going to be a C candle entry. So these are the kind of entries that you have to spot. And if you don't, you're not going to get it. So these are the ones, I'll show you later, but these are the ones that you're going to have to spot. And you can see why. I'll show you one more thing here. That the only direction we're going to take is short. You don't care. This really doesn't give you much to trade. I should really take that off. I was going to make a point, but it just doesn't work here. The point is that you're getting listen, what is this? This is a pivot. This is a pivot. This is a pivot. This is a pivot. So every sequential pivot. All right, hold on. Let me take a look at that, Ted. 1 second. And when every single sequential pivot is a higher pivot, that's where you have to look for that rising channel. Now, you have to see it, because I just want to make one other point. All those pivot indicators work in retrospect. You see, those they create those balls and all of that stuff, and they look great when you're trading the chart in retrospect. But this isn't going to be logged in as a pivot until the candle's all the way here. This isn't going to be creating a pivot until the candle's all the way up here. You have to anticipate this retracement back into this channel and the move up. Anticipate the move back into this channel and the move up. Now let me take a look at your question, Ted. Now see the B in the bear failure doji. Let me look at that. Can you tell me what time that is, Ted? See the times down here? Can you give me a time or approximate time? Okay. I see it, yes. That is a B. But no, that's not a close B. Here's the thing. First of all, okay, here's the mistake you're making. Let me just show you. And it may not be a mistake, but I can just make that clear. I just have to find the cursor here. Here's the A, that first red candle. The first green candle is the B. The doji failure, or this failure here, was the potential C that never evolved. So the whole ABC pattern is gone. And the B actually came far away from the A. Now there is no ABC technically on this chart, but that's the A. Here was the B, and then you had the potential for an engulfing candle, but it just didn't mature because the price went up too high to allow this candle to engulf to the downside. So the ABC pattern just vanished. Okay, I hope that makes that a little bit clearer. Now, here, this may look like a lot of random craziness, and to some extent it is, but it's not so random or so crazy. Here's the most important thing to see. Although you don't have really tight consolidation, it's tight enough right here. And you always know that consolidation is working when you never have the same color candle in a row. Like as the channel forms, here's a red, here's a green, here's a red, here's a green, here's a doji, here's a red. So when you don't have two red candle bodies, there's no way this channel can fail. It's a channel. Now with no indicators to help you, our indicator, our consolidation indicator, would take you into this trade right off of that candle. You're going to take the first break of consolidation, which is going to be the next candle, and you're out. Now, I think of all the things to see, that is the most important, because these are really high probability wins and very low risk trades. When you trade out of consolidation right off of resistance to the short side. Now you can see that the 50 is kind of stuttering along. You don't want momentum to be going against you, but you can see it's green, it's yellow, it's green, it's yellow. As long as you don't have momentum against you, you're okay. Now what you have is you have finally a bread and butter retracement and continuation. And this is really the first retracement in the trend. Or it could be considered the second. Because here's the A. Here's the B. No, I take it back. No, it is the second. Because you never have two greens in a row. So you continue in a downtrend. Now that your classic ABC pattern fails and you get another loser, and that's why price action traders do so poorly, you wouldn't trade this. This does not conform to our trade entry parameters. This is not a dark cloud cover and it's way off of resistance. So we're not going to take this candle short. We're going to let it go into consolidation and take the trade out of consolidation. Then we take the second retracement into continuation. And then if you really feel bold, you can take the third trade out of consolidation, right? I'm sorry, the third retracement and continuation here. Now, these are very tough patterns to see, but if you watch them, they will make you money. Now, they're only telling you who's in control of the market. And what you have is you have a lower high, lower high, lower high, lower high, lower high, lower low, lower low, lower low, lower low, lower low. 1, 2, 3, 4, 5 in a row. Now when you have this pattern like this and it peels off the modified 15, this is not an ultra conservative trade. All I'm doing is I want you to see them, so when they create more conservative patterns, you can spot them. What makes this conservative is that it's a channel into the trend. The trend is down, and the channel's down, so that you know. Look at the slope of the 50. The slope of the 50 is showing you that you're trading with tremendous momentum to the downside. The channel is telling you that the bears are in control. Now, the really interesting thing about trading a channel is that if you don't accurately trade the right exit, you don't lose money. If you took this trade out of the channel right here, and let me use the arrow here, you got a first target. If you traded this out, Now, this is why you need indicator help, but this is also why you need to spot them. This doesn't break the top of the channel because the bears are so firmly in control. If this wick doesn't hit your first target to give you a re-entry here, you don't stop out, and you wind up getting this whole move to the downside. That's the importance of just being able to ascertain these complex patterns, because they're going to give you potential entries. And the thing is, if your assessment is that these potential entries are too risky, you can step aside on them. There's no mandate to take a trade, any of these trades. I think if you don't take this trade at consolidation, you're never going to make money. If you don't take this first entry or this first exit or the first retracement, it's really the second, and you can call it the second, I don't think you're going to make money. But on these tougher trades, if you see them, understand them, and make an informed decision to stay out of them based on risk, it's not a issue. It's all based on your risk tolerance. As long as every time a similar trade comes up, you don't take it again. Your risk assessment and your trading plan should lead you to step aside or to take every trade that has pretty much the same associated risk. So if your plan is to step aside on this falling channel when it peels off a resistance like this, then you have to do it all the time. Now, like I said, you know the bears are in control, and you know the trend is short. That's what makes this trade a lot less risky. If this was a counter-trend channel, this would be a much, much riskier trade. All counter-trend channels are tougher trades. So we're just making an assessment of risk and creating the ability to see the trade. Just jump here. Study here. Now, I hope what's on this chart sort of jumps out at you, but I bet it doesn't jump out at you quite as much as it should. Now, here's where I'm going to show you something that's not so subtle, but it's really going to help you take a trade. Remember that 12-tick rule on candle body size. This is not only a retracement and continuation trade, it is also a trade out of consolidation. And when you add the trade out of consolidation, now you're going to get, remember, technically, at a classical consolidation, your entry has to be here. Later, we're going to show how our consolidation indicator is going to hand you these entries. But what I want you to see here is that the entry, and I want you to be able to see this in your head before that triangle comes on the software, is that this is not only a continuation trade, but it's a trade out of consolidation. That combined makes this a trade you must take. It's got such associated low risk. Now, here's your standard ABC entry, which if you don't take that trade, again, you're not going to make money trading anything. Stocks, futures, or forex. And I don't see these much anymore because the markets are trading so poorly, but this is like an around the corner trade. It just breaks around the modified 15. The modified 15 rolls red, and on the entry, you get that first solid modified 15 red color with the red 50. Well, I'll go back, Ted. Don't worry about it. And you've got that entry short. But what I wanted you to see, again, here. Oh, let me see here again. Hold on. This is just standard continuation. But here's what I was looking at. Here, again, I'll go back. Is a trade out of consolidation. It's not only a continuation, but you can see these candle bodies are not 12 picks in the aggregate. And they're 4 candles long. So this is not only a trade, a continuation trade, it's also a trade out of consolidation. That puts that trade in a whole different ballpark. And then if you look at this trade too, you have the same thing. That's why I'm always looking for that next up close, so I can take the trade out of consolidation, not just chase the continuation trade. Now these are great continuation trades, but when you get to this one, maybe you want a little bit more confirmation. Remember, this is the third retracement in the trend, but now if you're trading out of consolidation, you've got your confirmation. Now on the fourth retracement on the trend, or you want to have a little more conviction, now you're trading out of consolidation. Now hopefully you're going to get the consolidation signal and see that you're just taking a continuation trade, and the continuation trade at consolidation is powerful. It's a powerful trade. So that's really what I wanted to do. I wanted to show you that when you look at what seems like a continuation trade, look and see if it isn't more than just that. Look and see if it's a trade at consolidation to give you more power to take that trade and get into the winner. Now, Ted had a question going back 2 slides, but let me jump back. Previous slide had 2 reds and then 2 greens, and we wound up trading short. Let's see. You have to give me a location was where you had the blue arrow. Okay. You know what? Well, like I said, that's a multi-candle pullback. But you remember, Ted, it's a little bit tough. What we're trying to do here is if you trade the pure price action, the only thing that you can trade is a long trade. And this is why what I did was take the first 2 lectures and create just price action trading. And if you were just trading pure price action, you were completely correct. But price action traders don't create market structure. What we're doing with channels and triangles is we're adding market structure to price action. Remember, market structure is just not the 50 and the 15. Market structure is created by a series of falling candles or a series of rising candles. That's telling us who's in control of the market, the bulls or the bears. Now, we know when we're trading below the 50 and below the 15 that we're not going to take this long trade because we're going to adhere to our market structure rules. And we know if we take it, this is a counter trend trade. And we are not going to trade counter trend in this scenario. We have no reason to trade counter trend. In fact, if anything, what we have here is we have a series of lower lows. I can't do it exactly, but you can see that the market's weakening. that the bears are clearly running the market here. So what we're doing is we're adding a layer of sophistication onto our trading. Now, there are traders that just trade price action, and they get a lot of winners, but they're going to pull in one ton of losers. What we're doing is we're adding more specificity and more sophistication. Right off the bat, we know that with the 50 like this, and the modified 15 in general, falling, we want to trade short. That's why we're abandoning strict price action rules and we're combining price action with market structure to censor bad price action trades. That's why we're not going to take that trade. We're not going to look for that continuation trade long. If we have all these people out there that swear by pure price action, and that's the way, because that's the way God wants us to trade, blah, blah, blah. Well, you know what? If you trade pure price action, you're going to get creamed. And that's a really good example. Now, on pure price action, this is not a piercing candle, and it's no entry anyway. So you have to just stand aside on the entire formation. But when you see how this market is weakening, and the key is the pivots are falling. Every swing pivot high here has a lower high, has a lower low, a lower low, lower low, lower low. You almost can't get burnt on the entry unless you take the breakout candle of the channel. And that's just bad luck. But in this particular channel, any entry here would have gotten you a winner. And the one that I signaled with this down candle, with this arrow, does come back on you a few ticks. Then it gets engulfed and you get a nice win. Now you can see how much time and effort it takes to master this. This is a very, very complex science. It's not an art, it's a science. And it's very, very complex. But it's going to make you a really, really good trader. Now, we don't see this kind of volatility. This is a crude chart. And this is when crude was moving like, it was trading 300,000 contracts and had unbelievable volatility. And we're not seeing that right now. We saw very, very few candles today outside of the inventory report. Yesterday, crude was a dog with fleas, and crude's not been trading that great. But this is what we want to use, and this is how we have to trade. Now, I put this slide up for a reason. I put up every slide for a reason, but there's a specific reason here. And I'm just going to tell you right here, in here, there's just a whole bunch of chop. Now, remember the one thing that we have to think about. When the 50 is green and the modified 15 is green, we're only looking for a long trade. So let's just keep that in mind. And that will help our clarity and stop us from looking for a short trade, because now we're trading with structure. So if we look through here, and also we want the 15 to cross the 50 to the upside. Once that does, we have a license to trade long. Now, we do have a potential long trade here, which I saw when I was reviewing the slide, but it's an awful trade. And we would never take it. For our purposes here, we're going to say it's into the point of control, but it's way off support and it's just not tradable. And there's nothing here that is tradable except for one trade, and this is another reason why I wanted to highlight this slide and why I added market profile here. Now, market profile just adds more structure. It's just another area of support and resistance besides the 50 and the 15, in which we have to stand aside when we trade into, and we can trade off of once it breaks. So when we're in this whole mess here, you know what you can do? Relax and say, I can't trade anything here. I can only trade long, and here is the stop. Here's the area I have to get above before I can take any safe trade. And if you do that, you save yourself a lot of headache. And if you're trading another chart, you can turn your attention away from this chart because there's nothing. As long as you know, as soon as you break above, the value area high, that's where you're going to look for a trade. And this is why I put this in here. This is a really nice setup, but you really have to be sharp to get this trade. But I would like everybody in this room to get it, and I have to get this trade. You have the break, and you have the retest of the point of control, and it also does not break the modified 15. So you break the you break the value area high, come back to retest the value area high. It doesn't break the modified 15, and what you've got yourself on the right edge of the chart is an entry right here, and that is a Wallapalooza entry. You're taking it with the trend in the direction of the 50 and the 15. You're trading above the point of control, the value area high, above the modified 15 on a break and retest. So as soon as you break the value area high, you look for that potential retest and continuation long. And that's a setup perfectly. And unless you're vigilant for this trade, you won't see it. And the other thing, again, I just want to reemphasize, is that don't wear yourself out looking for a trade in areas where there just is no potential for a trade. Just let all this market structure and chop go, because you can't take a low-risk entry with resistance sitting right above you. And that's really what I wanted to highlight, how price action and market structure provides you with difficult entries, but also allows you the privilege of seeing that they're just areas I can't trade. So let me turn my attention away, or let me go get a drink of water, or a drink of whiskey while I'm trading, and wait for price to break above resistance and then retest resistance. And the quicker it comes back to retest, the better. And when it comes off resistance, which is now acting as support with an engulfing candle, you've got a beautiful entry. And these are very low risk trades. Let me continue on here. I always think that I don't put up enough, and then I wind up with putting up too much. Let me just see how many stupid slides, because I've got a lot of stuff here. Oh my God. We're only going to do a few more, or we may have to continue the module, because there's so much information here. I don't want to put you on information overload. Now, I didn't even bother to make a blank slide here, because I wanted to just show this to you. Here's the same trade again, and this is not the same configuration. This is a different slide. You see this one here, and here's this one here. You break here, you come back and retest. Now, if you took the trade here, which I would have done, quite frankly, okay. You know what? I'll talk until my voice gives out. Now, let me tell you why you would not enter here, now that I look at it, and why I did not mark this off. On this trade, the 15 has not crossed the 50. And this shows how important the predictive value of the 15 is. You get a break and retest. Now, if you take it, it's really it's not a terrible trade. And you don't lose the trade. It comes back 9 on you, and it's going to give you a little bit of, your heart's going to go into an atrial flutter a little bit. But what happens is it comes back and tests again. Here the 15 has crossed the 50. And this one just flies in your direction. But watch the breaks and retests. It comes back, tests again. As long as the entry is an engulfing candle or a piercing candle to the upside, you're in it. And what I wanted to exemplify here is if you took this trade short here, and it's a great trade short, right where my arrow is here, it's going to come back on you 9 ticks, and again, it's going to give you, you're going to need to insert a cardiac pacemaker. But what it does is, it gives you an entry on a tweezers formation. That's why when you're going to be in the trade, but if for some reason you miss this first entry, and there's no reason why you should, everybody should be in that trade. But that's a bread and butter trade. And like I said, not every bread and butter trade works. I would say 80% or more do, and this is one that almost doesn't work. But it comes back all the way on you 9, forms this perfect tweezers formation, and blows down. And what I wanted to show was, if for some reason you didn't get in here, go right in on that second shot. Because this is going to wind up being the bonanza trade. So if you're sitting in the trade and you see it start to come in your direction, you notice the candle closes and moves. It's going to probably explode down because you've got a perfect tweezers formation here. Don't exit the trade early or bail out of the trade. Let this thing engulf and let it go down. Let it close and move down. Everything else here is tough. It's really tough. And I looked at a lot of other trades here. There are no real low risk trades. And I'm just looking at trend trades here. I mean, here's a pretty decent counter trend trade right here, which I do like a lot. But I don't want to get into counter trend trades yet. Here's another potential counter trend trade right here. But remember, when you trade counter trend, it's always risky. It's consolidation. And a break to the downside. And I'm just showing you this only so you can spot them and either discard them or take them. That's all. I don't know if I would ever be in this trade, but I would certainly be watching it. Because what I would be looking for here is a break consolidation to the upside. Because I want to take consolidation in the direction of the trend. And I'm looking for a long break, not a short one. So, and really what I'm doing here is I'm thinking out loud to you so that you can see what's going on in my mind while I'm looking at the charts. I'm going to take this break and retest. It's going to come back all the way and then shoot up. This counter trend is tradable. This is not a tradable period consolidation because you're looking for a breakout. But this is a nice entry here and then gives you the winner on a completion of the tweezers formation. Okay, now, I was going to ask you some quizzes here, but some of this stuff is so hard. I'm just going to go through this, and we'll save our quizzes for later modules after you've had a chance to study this. But here's your break and retest. Now, this is not the most conservative trade in the world, but on this trade, the 15 has crossed the 50 to the upside, and the 50 is rolling. Now, you really want the 50 and the 15 to be green optimally. So you have to look in the upper left-hand corner and look at the slope. If the slope is like 0.2, no big deal. But when you break the 50, come back and retest the 50, should be in the trade. And what I like about this trade is the slope of the modified 50. It is just stoking up. And that's a nice trade. But there's going to be this is why a system is created to define risk. But some of the better trades, there's no dot or triangle. And believe me, with the strategy entry, we try to get as many configurations to fire that aren't classic, like a C candle or a move out of consolidation. But you get some great entries that are just never going to fire on any system. And this break and retest is one of them. Now, there's one other that I wanted to show you here. And let me see what it was. And then I don't know if there's anything else that was really that conservative on this chart. And that was the biggest thing that I wanted to show. I'll just show you this. This is a very, very tough trade. But because I want you to read what the chart's telling you here. Now consolidation is really here. And taking this trade out of consolidation is tough. It's not a dark cloud cover, but I just want you to see that it's a potential entry if you want to accrue the additional risk. What makes it less risky is you have the 50 and the 15 down. And your anticipation of a break in consolidation is going to be to the short side. If it comes with a consolidation signal, we don't want to talk about those, maybe you would take it. But I just want you to see you have a potential entry here that you need to assess. That's all. And here's what I want you to see here. It's very tough to take rolls. But we're looking at price action and we want to read what traders are telling us. And you can see you're getting two sequential lower pivots. Here's the second pivot. Right here. Now, I think that's a risky trade, but I simply am pointing it out because I want you to see that it's a tradable entry, but you're going to accrue some additional risk. You haven't broken the modified 15. You are on a nice big candle line. That's a nice dark cloud cover. And you are in a falling channel. The second open, as this moves down, once it completes the candle to the downside, you completed a lower pivot. So you're not going to get in the trade unless the candle completes to the downside. So here's what you make out of market structure here. Break and retest and continuation with the 15 above the 50, the 50 starting to roll, and a nice trade. A break out of consolidation in the direction of the trend, risky entry. A roll off of a sequential lower high and lower low, again, tradable entry, but risky. And you can see how the market's always talking to us with price. It's just a matter of being able to read it, and also being able to being able to discern when traders are telling us incoherent information, and that's when we stop. We don't trade. This is very coherent information. And so is this, and so is that. And I already marked this out. Now, I like this trade a lot. And I think if you don't take this trade, it's a mistake. I rarely say that. I'm only going to tell you that on the most conservative entries possible. It's a multi-candle pullback, but there's no way you're going to take a long trade here. This move to the downside engulfs the previous two candles. You're going to get that magenta dot above this candle. And you see here that the bears are telling you we are in control here. Now, if you took the short here, you're going to get a first target. If this is the CL, you're going to get 5 ticks, and you might even get, well, you're not going to get 10. But you've got an easy 5, and you might get, you're not going to get 10. You're going to get an 8. Then it's going to come back, and you're going to re-enter on a tremendously powerful trade. That's a winning trade and a must-take entry. Now I'm getting to the more, actually I'm going to be able to get through the slides, because the last few slides have such, what I did was I went for one discernible trade. And here is a difficult trade to see. This is not the same setup you saw before. This is a rising triangle. Because what you do have here, you can call all of these lows. So what you have is a 1 low, 2 low, 3 low, 4 low, creating this bar. And then remember, the lows come off the wicks. And then these two candle bodies create the rising triangle. Now, I think it is the same formation. It's the break and retest. What I did was I just elucidated it a little more carefully by showing you that you almost have equal lows and remember, lows include the wick, but the triangles themselves just include the candle line, which makes it doubly important. We take this break and retest and up. Now, this is actually the last slide. And what I wanted to show you was, and let's see, we're at 2 hours and an hour and 20 minutes, and this is a lot, is a counter trend channel. Now, counter trend channels are tougher to trade, and they are more dangerous to trade. Now, you have no entry here, even though that's an engulfing candle. I wouldn't short that. This candle body to me is too small. Even though you created the second pivot on the close, but I would take this third trade and its associated risk. And the reason I would take it is because this is an engulfing candle. It's a third lower high, a third lower low. It noses through the modified 15, although it doesn't break it. I would anticipate a break. And if you're really trading smart, you're going to take the trade right off its support. And you're not going to get a huge move, but on 4 contracts, this can easily be a $200 trade. And that's really what I wanted to show. And if you look here, you can see how the market's telling you here that the bulls are in control, but nothing happens. The trade just goes lower. I mean, you're looking for coherence in the market, and sometimes it just doesn't happen. But the one thing, and this is really how I'm going to end, the one thing that's really important, And here's another break and retest right here. And it's maybe the same one I was looking at before. I just don't remember. But I didn't mark it out. It's not. This is a different one. But it's happening pretty quick. And is that always set a direction for yourself? I mean, I try in the room. I may not try hard enough, but I always, in my head, I always tell myself whether I'm looking for a long trade or whether I'm looking for a short trade. The tough part of trading was today in the E-mini, where the higher time frames were all to the upside and our trading chart was to the downside. And when that happens, you saw how incoherent trading was today on the E-mini. We never got any follow through to the downside. We got 3 tick moves. We got 4 tick moves. We got 5 tick moves on big risk with no follow through to the downside. My only point being, when you trade price action and market structure off your trading chart, always set a direction for yourself based on what the candles are telling you. And they're always telling you something very clear. They may tell you that you're interested in taking a counter trend channel. If it sets up as nice as this, you're going to take it. They may tell you that you're going to take a move out of a channel into the trend, and it may be a multi-time frame trend. It may be a break and retest. It may be a move out of consolidation. But always in your mind, always be asking yourself, what direction is the optimal way to trade? What gives me the lowest risk entry? Where do I want to be here, long or short? What am I looking for? What do I want the market to do? And again, I try to do that in the room. I'll say I'm looking for an up candle. I'm looking for a down candle. I mean, I am trying to get the market to give me what I'm looking for. I don't take what the market gives me, hopefully. I hope the market gives me what I want. So that's exactly right. Thank you. That was similar to the winners we took in the room. Today in the room, we took 2 trades and they were both perfect trend trades. We had $200 on one and we got $100 on the other for $300 on 2 trades. Both my telling myself I want to go short, we got the short trade and it broke the pivot. The other trade was a counter trend trade, I'm sorry. But I told myself I'm looking for the pullback and the continuation. I'll take the counter trend. We were in way before the close of the candle and it shot up 9. And the last trade, which I didn't want to take the risk on, was again a nice counter trend trade, and that went 15 ticks. It would have given us a second full win. If you read the candles and you read price action and market structure, it's going to give you a very, very, very accurate assessment of the direction you want to trade. The multi-time frame analysis is going to help you. But right now, let's not look at indicator confirmation. Let's just look at what the market is telling us on our trading chart. Okay, that's obviously it's a good question, Ted. And Ted writes in module 3, price tested a pivot line, a high pivot twice, bounced down, and broke through the 15 to 50, going past both moving averages quickly, showing a lot of selling conviction and strength. Should we consider flying through both adds to the possibility of turning into reversal, which is what happened? Well, here's the thing, Ted, and I think this is part of our trading mantra, and I think it's a really important point, and that you bring up. And we don't have any really nice slides here. Let me try to move back and try to find a slide that exemplifies, because I know exactly what you're saying. let me just put it this way. I don't know what I think out here. A reversal trade, I don't think we can ever anticipate a reversal. I know what you're saying. But the only time that we're going to anticipate a reversal is when traders tell us, they're informing us with the candles, and it conforms to our price action market structure configuration. Now, I don't have, unfortunately, the NinjaTrader open, and it takes so long to load now with the cash quants. I mean, what we're looking for is, and I'll just draw it out for you. And you know, the one thing that 99% of traders do when they take moment, they call them Momo breakouts. And you should see how this platform trades on stocks. I'm telling you, it's a killer. But what they do is they anticipate that a break of a trend line, whether it's a high for the day or a 52-week high, will somehow lead to a continuation of the price. And we know that that is impossible. That's why we only trade retracements. That's the only thing that's going to guarantee that we get follow through to the upside on the trade, not the break, and we don't take these Momo things. Because ultimately they're going to lead to lots and lots of losers, or what they're going to lead to is a break and then a retest and then a continuation. And this is the best way to put it. I hope I'm answering your question, Ted. This is a break here. We don't have it of the 50. And obviously this is coming with a lot of buying conviction. So we're not going to look for potential reversal, because the reversal is only going to come when the institutional guys decide it's time for the market to reverse. And they're going to hopefully, but they don't do it on crude, they just blow through 35 or 40,000 contracts and push it in the direction they want. But when we get some mix of commercial traders, what we're looking for is the break and then the retest. Because we don't believe anything is going to guarantee a continuation of this move to the upside. Now, if the move just happens to go to the upside, which does happen, we can't trade it. So I know what you're saying, like this strong move up is going to then be followed by the counter trend move. And we just don't know when this move is over. That's the problem. It's got to be telegraphed to us. And you know that taking counter trend trades and trading tops and bottoms is so problematic. Now remember when we take a counter trend trade, we're not trading the high. And this is the last point I'm going to make. The market reverses here. But we're not trading this. We'll let all the other traders pile in and get this reversal first. This 75 to 80% of the time, these counter trend traders are going to get beaten up. What we're going to do is we're going to wait for a lower swing pivot, in which we create a lower high and a lower low. If we don't get a great entry, we're going to wait for another swing pivot. And we're going to take a lower high and a lower low. And we're going to take that one. So we're not trading off the top. We're letting other traders hit that first. And we're letting them reverse the trade. Let them get that first winner, so they can pull in 6 losers in a row. What we're going to do is we're going to wait for the market to start showing strong bearish signs, and we're going to come in later, and we may not get as much on that particular setup. But when we take trades, our trades are going to be much safer. And that's what that trade is. We're trading closer to the 50, so our potential profit is less, but our risk is much less. And if you want to take risk, take the risk here. But we're not going to call a top and we're not going to call a bottom. Now, I was going to put in a whole bunch of slides about double tops and double bottoms and trying to trade off the top and trying to trade off the bottom. And there were 4 or 5 months, a year and a half ago or 2 years ago, where I did my best to trade off the bottom or the top. You can't do it. You got to wait for other traders who've been run over 17 times already to call the top. And the great counter trend trade, and I say this with, if this is trading with red order flow and momentum, risk is much reduced. If this counter trend has red order flow and momentum, much risk reduced. But that's really, I think, what we're trying to do. We'll let somebody else call the top, and then we'll move in and we'll take the safer trades. If we don't get a trade, it's okay. If the market just comes straight down like that, it's all right. They're going to get crushed a million times for the 2 or 3 big winners they get. So listen, that's it. Now we're going to take a break from price action and market structure, and we're going to be on these Wednesdays. I missed one and then I missed another, but I want to have momentum with these modules. Now everybody's here who's here is going to get this on a link. We're on EverWebinar, so it's being recorded right now. So you're going to get that. Next week, we're going to move to volume, take a little bit of a break. Then we're going to come back to price action and market structure again. And I'm going to go over, I'm telling you, we're going to go over 100 slides. And each slide I'm going to go over is, I'm going to try to highlight one single configuration. And then we're going to start looking at trade management strategies, how to build an ATM strategy off of an entry, like what do you set as your first target, second target, third target. And this is not if you're trading the E-mini, it's if you're trading Google or Netflix or a whole different set of instruments. What are you going to set as your ATM? What is your goal? And we're going to set those up. Oh, well, listen, Ted, I'll tell you what we're going to do. Thank you, Keith. I really appreciate that. What we're going to do is, in the next price action market structure module, we're going to go into counter trend trading. Now, I did here. This is a counter trend trade, and this is a counter trend trade. But I'm going to break up, and I'm going to show you the perfect counter trend trades that we take. But I can just tell you right here, this is really what they are. It's the break of the modified 15, the retest of the modified 15, and the continuation. It's simply the variation of the break and retest. Those are very high probability, low risk winners right here. Now, that's different from if price is down here, kind of meandering around, and it comes up to resistance. You can also trade those short, but what we've done in assessing that move, it doesn't have the kind of risk that the break and retest and continuation does. But now that we've seen the power, and I don't want to, I think, I'd be remiss if I didn't add this, of order flow and momentum in our direction. If price meanders up to resistance, and then we get a continuation candle right off resistance, and it's an engulfer or to the downside, it's a dark cloud cover in the direction of order flow and momentum, we'll take the short. But this is our classic: break, retest, continuation. Break, retest, and continuation. Not trading into the modified 15. Not trading into the modified 15. Those are low risk, are most low risk counter trend trades. That's the counter trend trade I took today on crude that went 8 or 9. It was the break, retest of the 15 and the move up. And the one that I passed 5 was the same thing. It was the break. It tested, came up, tested again. Order flow and momentum rotated, and the thing went 15 ticks. That's the trades we're looking for. So listen, everyone, I hope you learned a lot from this. I'm really trying to convey an enormous amount of information. And you're not going to see this anyplace else. People are just going to tell you about how to trade their indicators, and right now, you don't want to learn about indicators. You want to learn about understanding what the market is telling you with price action. And you can get similar price action with time and with tick. I think the best is with range, but time and tick will also convey this information to you as well. So listen, everyone, have a really, really great afternoon. If there's anything that you still don't understand, I'll be more than happy to give me a call or send me a JPEG. I'll be more than happy to do that. If you want to show me some entries or some big configurations, I'll be happy to mark them up. So have a great, great afternoon, everyone, and I really hope you learned a lot. Take care. Thank you all, guys. Bye.